I was having coffee with a friend of mine the other day. He's an angel investor type and reviews a lot of pitch decks. So naturally, I was talking with him about my new book on innovation timing, as you do. And he listened politely for a while, asked some great questions, but towards the end said, listen, I have to help you understand kind of what my day-to-day looks like when I'm evaluating a pitch deck as a potential funding source for a new venture. I'm looking at three things. We've got the team, the people who are involved, the technology, the idea, and the go-to-market strategy. And he said, you know what? We feel like we've got a pretty good idea on how to evaluate the team. We get to know them and we really understand them. Great. And, we bring in the engineers and the technical people to really understand the technology, ask a lot of questions. Great. But we really struggle with the go-to-market strategy and evaluating how good the founders have really done at crafting a believable go-to-market path. And he said, if timing can help with that question, then, hey, I'm really interested. So what I did is I thought to answer that question in a little bit more of a succinct way, I drew some pictures and I did a video. So let's check it out right now. So here's my chart for funders and founders on how to think about go-to-market strategy. There are really just two things to think about. You have a thing, and people over here want that thing. Now, there could be people influencing those people who want the thing. There could be doctors and patients, all sorts of things. But again, very simply, there is a thing you have. People want the thing. There is a value proposition for that thing, that the reason they want it, and there is a path to get it to them. That is basically it. There are just two things to think about. The trouble with that, if we can move right over here, and next time I'll do this with some colors and make it a little bit easier to look at, but this is V1 right here. So version 1. We'll go to version 2 later. As much as founders that I feel talk about creating the future, they're going to make a fundamental attribution error. This is their slide deck. We're disrupting a $1 trillion industry or some such nonsense. There's the time index pitch deck does not equal time index in market. Now, they might not be going to Walmart, but you get the idea. There is a gap in time between these two things that is critical and is really the miss. Most people are thinking that this will equal this in the future. And we know that markets always evolve. So eventually this question, what is your value proposition and what is your channel, matters more here than it does here. And we confuse these two all the time, and they are not the same thing. So this one, more important than this one. So when we take a look at this go-to-market, the value proposition and the channel, now and in the future, we get the McKinsey, BCG, Bain Consulting 4-blocker. And if you wouldn't be a good consultant if you didn't have a 4-blocker, so we made a 4-blocker. See that? Isn't that nice? We have 4 go-to-market questions that you need to answer. Value proposition and channel, now, and once you get into market. So there are kind of 4 ways to answer that question. Founders, don't pitch people anymore until you can answer these questions. It's exhausting for funders, and you're going to embarrass yourself. Funders, don't keep giving these guys checks for value propositions and channels that have no sense of what the final market will be. What they're promising you today will not be what happens out here, and there needs to be a credible plan. So both of you guys are on the hook for this. So let's actually start to answer these 4 questions. The first one we're going to do, and you could go over here if you want, it doesn't really matter which way you answer these questions. They all need to get answered. Value propositions over time. So see this little chart, the little 4-blocker? We're answering those first 2 right there. So value propositions, lots of ways to do this. I like for it's that unlike. Very easy to construct this in your head. Once you remember it, it's called a FITU. It has a neat acronym. So FITU, which is kind of easy to remember, right? I like that. I like things that are easy to remember. For is your audience. Who is this? Who's it for? It's always the first question. What is it exactly? I wish I wouldn't have to have this in here, but gosh, there have been a lot of AI things that it's not really clear what exactly it is. It's not like that's different. The internet was the same, computers were the same. Every time there's too new of a technology, this it gets weird. That is the benefits. What benefits does the audience get from using it? Those are the benefits. And what is the alternative? What's it unlike? What's the next best thing? So let's start to ask, what questions do you need to answer now? So when you're seeing the pitch for the first time, these are the questions you need to ask to make sure it's really clear what this value proposition is. The audience, is it clear? Is it really clear who you're going after? If you've got a medical device, are you going after the physician? Are you going after another clinician? Are you going after a healthcare administrator? Are you going after the patient directly? What is it right here? Is this crystal clear? Every time you have more than one audience, let's say you have 1, 2, 3, each one of these needs its own value proposition. And if you don't, don't conflate these. These are different people. The second one, is it emotional? Lots of engineers and technical people have a very good rational reason why all this makes sense. Humans do not make decisions based on rational. They rationalize. The rationalization process is emotional. What emotional pain are you going after right here? And then finally, are you trying to reach a unicorn person? You need to make sure, and this will tie over to the channels, so pay attention there. Can you actually reach these people with sales and marketing efforts? If you have to basically reach everyone in the United States, or you need to reach all doctors, or you need to reach all people who want to do home improvement, that is a tough situation. That's very expensive to do. That's Super Bowl advertising. Can we get more clear with that? You don't really have a target market if you can't reach them. The next question is the it. This is my test. Do not ask the founder to explain it to you. Ask their audience to explain it to you. Don't believe what they tell you. Believe what the audience understands it to be, because if they can't, you've got education to do. If you have education to do, that takes time, that takes money. So make sure that, hey, you've got a review of the product that tells you this is in the customer's own words what it is. That's what you're looking for. That is the acid test right here. Benefits are, do the benefits naturally flow from it to the audience? Here's an example of that. Let's say you have a product that is designed for orthopedic surgeons during complex hip replacements. You have a new surgical instrument that helps take some of the burden off of this process. It's very physically demanding for the surgeons because these are big bones. You've got a tool that will help them do that. The benefits, and here's the problem, the benefits often come from, well, they have less time in the hospital, or even worse, and this shouldn't be worse, but it's worse from a benefits perspective, better clinical outcomes. No. The product, remember, was a piece of surgical equipment that helped the surgeon reduce the burden on actually handling these really tough, big bones. State that benefit. Surgeons are happier after that. They're less fatigued. They need to spend less time in the operating theater. Great, you can always get to the next step of being able to take a look at those second and third tier benefits. That's great, but lots of times the primary order benefit is not clear, or it's jumping too far. This is the key place where founders oversell what they have to this audience. This audience will not believe that this can do these high-level benefits. Undersell right here, you can always get better. And then finally, what is the next best alternative? And usually, very often with new innovations, things that are really, really new, the alternative is nothing. They are not doing anything right now. When you see that, and you'll see it a lot,
Is it really that this audience isn't even really aware there's a problem to be solved with this value proposition? Do they need to be educated on the problem or just educated on your solution? Anytime you are further back in that chain in time, count more money and count more time for that to happen. So again, this is answering this first block question up here. This is it just for this value proposition today. What's more important, though, is how these things change over time. Okay, so let's get to some of those questions. First, how does audience perception change over time? Audience perception always changes over time. Things that were expected become ordinary, or things that were extraordinary become ordinary over time. We'll talk about that a little bit more here. Hey, but sometimes people age out. Different generations take over. They have different perspectives. Need to make sure if you're having a major switchover in these surgeons, for instance, remember those. Let's say you get a whole bunch of retiring surgeons and now the younger surgeons are coming in and they're stronger, they're fitter, they don't need as much support for your product. Will that change by the time you are ready to be in market 6, 9, 12, 18, 36 months from now? Be careful. The next one is the offer, and I see this all the time. People are evaluating the roadmap. That's usually what happens here in the technical area of evaluation. This is a different question. What you're asking here about the roadmap is it continuing to deliver to the audience these benefits, or is it starting to drift? And here's where you run into this little guy. He's called technical debt. In the rush to do MVPs, minimum viable products, over here to get something out into market fast, we incur technical debt almost always. Those are bad decisions you make to get something done fast. So your roadmap inevitably is going to need to address technical debt. Think about technical debt as a debt, like a financial debt you as the funder are going to pay to fix that. When you're fixing technical debt, you are not delivering value for your audience. So look at this roadmap, and if you see lots of this, make sure that you aren't the one holding the bag for that. Finally, this is how do benefits change over time? I hinted at that here. This is the Kano model. This is in my book, by the way. You'll read about that. And there's a concept called the decay of delight. And here's what that means. The Kano model is really fascinating, but all you need to know about it now, I'll do another video on the Kano model because it's so cool. But the decay of delight means that all things that were extraordinary and super cool and exciting eventually become something you just expect. You intuitively know this, and think about the Wi-Fi on an airplane example. At first, you get Wi-Fi on an airplane and you're thinking, wow, this is the coolest thing ever. I can't believe this. I'm so thrilled. Now you get on an airplane and it doesn't have it, or the Wi-Fi is not working, and people are pissed. So again, this is one of those things that happens very fast with technology, that the wow becomes meh fast. And that the faster the technology cycle, you're talking about AI type technology, this decay of delight will happen in days or weeks. So by the time you're in market, you've probably already gone to meh. So I'm just going to call this the meh right here because I like that. I like that word. Meh. And okay, I said this was finally, but this is really final. Most of the time, and this is something I hear from founders, is that they are way smarter than their competition and that everyone is dumber than them. And I get it. And a lot of times they're right, that they really are the smartest people in the room. The problem is that your competition isn't stupid, and if they are stupid at point A, they're dumb here, they will not be dumb here. And why is that? Because you told them how not to be dumb. They watched you and they said, wow, holy crap, look at how smart that was. I'm just going to copy that. And you think, well, we have a patent and we have this and we have that. Your competition will look at what you did and work around you. That's what they always do. You need to have a plan for how they're going to respond and how you will respond to how they will respond when you are in market. So again, This is the value proposition right here. These are the questions you need to ask and things you need to be looking for in the pitch deck or in the follow-up conversations with the founders. Okay? Let's make our last move over to channels over time. Sorry, my tripod's in the way here. I'm not going to move that because that'll shake the camera, and that's really hard. In the future, I'll have something that is higher and has better lighting, but today we'll deal. Okay, this is, remember, V1, minimum viable product. This is technical debt that I will need to fix later. Channels over time. We're answering the bottom two squares right here. Okay, what does a channel look like now? What are you looking for as a founder and as a funder? Well, I'm looking for this thing called traction. Like, what is that thing where I'm starting to get a sense for product market fit, founder-led sales? What I'm really looking for here is show me that people are actually buying this thing. And the reason I said really right here is that for this target audience, are they buying the product? It's not just friends and family and people I know really well. People in the target market that I do not know are buying this solely based on this and not based on that person. So this part is key, and this is tricky to tease out, but you're good at this. You can figure this out. What you're looking for is, from a pricing perspective, pricing is a signal at this point. No one's making any money here. If they were making money, they wouldn't be talking to you. Okay, so price is just a signal of commitment and appropriate value exchange. If no one's willing to pay it, or they're willing to pay not enough in order for you to make money, and they are not paying at all, they just aren't really ready to make that commitment, that is a sign that you don't quite have product market fit just yet. You need to keep working on that. So again, I think most funders are pretty good at answering that type of question. What gets tricky is now when you are going into market. And most of the time, the founders are not making that decision right there. How are you going to go to market? What channel or channels are you going to use? Because any one of these that you pick, and there isn't a right answer or a wrong answer. Sometimes people make the, like, well, everyone else is going in distribution, I'm going to go in distribution. Or everyone else is doing Amazon, I'm going to do Amazon. Again, that's maybe the right answer, the wrong answer, doesn't really matter. But when you don't pick and you don't have a plan, and what I mean by a plan is, have you answered all of these sort of questions for whatever channel you pick? The price you sell matters a lot. If you go retail versus distribution, you need to make sure that you have enough margin in it for each of these folks to make money. If you do that and you say, well, I want to go direct, I don't need to pay those fees. Great, you still need to pay staff and compensation for those staff. Selling is not free, and you are not going to do it anymore. That doesn't work. Reps are the same way. MLM stands for multi-level marketing. It's not just a scam, although it can be, but any of these can be scams. You need to figure out there needs to be enough margin in it for that. Amazon's notorious, your own web store. With Amazon, I don't need as much tools or infrastructure. My own store, I do, but I'm going to pay for that, and I better have a higher price. Whatever you're going to choose, you need a credible answer to all of this. A lot of times there's hand waving. Hey, we're going to sell on Amazon because our competitor does, or we are going to go direct because everyone else is in distribution. Great. What are your answers to all of these questions? And if you don't have a good answer, don't give them money until they do. The biggest thing that I take a look at here, though, the number one question is, how long do these take? So again, when I want to do, for instance, direct sales, takes a long time to get into market. Retail can take a long time. Distribution can take a long time to get into market. Some of the fastest, okay, Amazon might be one of the fastest. Your own web store might be one of the fastest. Reps can be pretty fast. It depends on the market and depends on what you're trying to do. But when you think about how long it takes to get into market, what you're really thinking about is, How much money do they need to make sure they know how this ramp up is going to happen? This ties directly to the financial statements you're looking at. And without that decision and without these questions, those financial statements and those sales projections are complete BS. And you should know that. So this is it. This is go to market. It's simple in one way. There's a value proposition and a channel, but it gets complicated in a hurry. So take this 4 blocker, take a look at what's your value proposition today? How does it need to change once you're in market? What's your channel today? How are you doing founder-led sales? How are you learning? And then how does that need to change once you're in market? You answer those 4 questions and maybe you've got a deal.
All right, that's it for this video. Investor types. If you're listening to this and watching this, did you find that useful? Does this make more sense than what you're doing right now? What did I miss? Add your comments below and I'll answer them. Until then, see you on the next one.